Over the past 6 months, we've been talking a lot about the Fed and interest rate hikes over the back end of this year and the possibility that they could go on hold by October. We think that might have to change now. We think maybe the pause might be the first quarter of 2023. The reason behind this is twofold. First of all, the Fed has been very hawkish recently and saying that they'll have to kind of increase rates to fight inflation, and that the well could be paying in the economy first before they look to kind of reverse that situation. So the Fed's going to stay higher for longer. That's the first thing. And second is that recent visit to the US really kind of showed up the kind of levels of job opportunities in the US, because there seems to be a real shortage of staff, particularly in the service industry. The hotel we stayed in, you had to take breakfast in your room rather than go downstairs for breakfast because there was no people to serve you. So I think this will keep the jobs data kind of higher for longer, in terms of that the unemployment levels won't start to fall for maybe another few months than we expected. And given that the Fed is very data dependent and jobs is one of the big aspects they look at, then we could see that continues to be more aggressive in its stance in terms of increasing rates and keeping rates higher for longer. So that's where the shift is at the moment. So that's obviously not going to be liked by the markets, and we would have to wait and see how that impacts the overall economy. And one of the things that we've always talked about and continue to think about is the unintended consequences of higher rates. I think the next few months we'll see how this plays out.